with all of these new apartment complexes coming online, this presents a new variable that you should be paying attention to as you invest, even in these top markets like Phoenix and Austin and your other Sunbelts, Atlanta. Welcome to the Cash Flow Chronicles. I'm your host, Jonny Catani, and the founder of Catani Capital Group. For the last 2 years, I've been studying alternative assets and now help solve the problem of creating passive cash flow for creators, influencers, and busy professionals by bringing you 5 episodes a week of easy to understand education in the world of passive investing. What's up, guys? Happy Friday. Welcome to another episode of Friday Follow-Up here on the Cash Flow Chronicles. I am your host, Jonny Catani. I hope everyone had a great week. Hope everyone has awesome weekend plans. We are once again battling storms every single day here, but we shall persevere. I'm hoping that we can still count this as spring, quote unquote. And when summer comes officially here in a couple of weeks, that we have a little bit more predictability when it comes to sunshine, because I'll tell you, it makes it tough to make plans when you're not sure if it's going to rain every day. But it's still warm, and I like that. And the storms are cooling it down to where you can actually still open the windows at night, which is actually kind of nice, not gonna lie, and not something I've ever been able to do this time of year. So anyway, you know me, always make at least one mention of the weather. I've realized, in fact, someone called me out on it a couple of weekends ago. They're like, how often do you check the weather? And I was like, maybe too much. But that's only because I like to know when the rain is going to come so I can kind of plan my day around it. Because normally, legitimately scheduled in my day is every afternoon, I go outside, pull out a camp chair, and my dog and I literally go sit in the sun. And I either read, sometimes I just sit there for 30 minutes in the sun, shirt off, and just catch vitamin D and get energy. And that's been interrupted a few days every week, which is kind of a bummer. And then you won't see the sun. It'll always blow through, but it won't be till later in the day when it's just not quite the same. And a lot of times even later, it's like 7:30. So that is one bummer, because I like to go out there. My favorite thing to do is go out there and read. And that's typically my reading time for the day. And I'll take 30 minutes and read right in the direct sunlight. Usually end up sweating, but you know, it's kind of a 2 birds, 1 stone, right? Get my daily vitamin D and also get my daily reading in. So that's why I mentioned that, and that's why I checked the radar a lot. But I got called out, and it was pretty funny. So anyway, that's obviously not what we're going to talk about today. So what we're going to talk about today is we are going to talk about, so we've done a lot on, like, you know, the who, what, why, when it comes to investing, right? Picking your, you know, developing your investment thesis and your risk tolerance and all of those things. So now what we're going to talk about, what I want to get into, is we're going to talk about the kind of the fundamentals behind, like, choosing your markets, right? So this is obviously very, very important, right? Because real estate is all about location, 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 right? I mean, that's everything. And depending on your market, you know, like, for instance, take Dallas. Dallas is down to like the block, where like the block could be the difference between like a C class and a B neighborhood, and a C class and a C neighborhood, and the crime and the school district. And then in Houston, it's something, the difference between like flood zone and not. So that's going to change your insurance, and that's going to change a lot of things, right? So it's very important to understand the markets that you're looking at. And I realize that when you find a good operator and a good, you know, that has been working in the same market for many years, they have a good track record in that market, it can be easy to just follow them. And I'm not saying that's that's wrong, right? Because, they've done the research and they're going to share it with you, right? Like it's going to be in the offering memorandum, but what they show you can be subjective. So it's important to, in my opinion, it's important to go and learn it yourself, right? To understand those different things so that you're aware. And so that if something happens, you understand what you're getting into, right? Like if you're getting into a C class, it might be in a bit of a higher crime area, but the returns are higher and you're aware of that and you understand why that is, and you're like, okay, I'm willing to be speculative, then you can't be mad when it takes longer to implement the business strategy of kicking out the current tenants because they're having to call the police every day. And yes, this is a real thing. So that's why I bring it up. So what I'm going to do is I'm going to start a series on market research and how to properly understand what you're looking at and what's important, what's not important, and why. So the reason I bring this up is because what you're starting to see is you're starting to see a massive amount of new construction come online. Something like, I was researching, something like 950,000 multifamily units are under construction. So almost 1 million units under construction nationally. And what that does is that saturates the market, right? It doesn't matter what market you're in. So let's say you're in a market like Phoenix that is already experiencing a flattening of the rent, which we knew was coming, right? Because Phoenix, Phoenix went up so high, so fast that it's only natural that it corrects. And what goes up must come down. So, if you go up 25% and you drop, 8%, you're still up, what's that? 17%, right? So, over, long, right? Over a long-term period. So it's important to understand the different variables at play. Okay, why is that, right? Why is it coming down? Well, part of that is because there's a lot of new units coming online. And what happens when new units come online? I believe I've talked about this, but I'll explain how development typically works. So typically developers, their only goal, the only thing they do is they develop. They don't have the goal of, I'm going to build this apartment complex and then I'm going to hold on to it for 3 to 5 to 7 years and operate it. Typically they come in, they build it, and they want to get out. Now, that's not always the case, right? There are groups who have a development arm. So they'll do, already build acquisition, right? So your typical acquisition of an apartment complex that was, built 10, 20, 30 years ago, yada, yada. But, and then they'll also have like a development arm where they're building new stuff. You see this a lot in self-storage, just because self-storage, the barrier to entry on development is a lot lower than it is for a multifamily. But it's important to understand what new builds can do. And typically what they do is they saturate a market. And then because developers aren't looking to hold on to something, what they'll do is once it's built, or let's say it's in phases, right? Let's say you're building something massive, like 450 units, you're going to build, 150 at a time, right? And bring them online in phases. But in the meantime, what you're doing to ultimately be able to position this thing to sell, so to, ultimately to be able to do one of two things. If you are going to hold on to it, well, let me rephrase that. Your next goal after it's built is to get it stabilized. And the two biggest reasons are typically debt, right? So after a typical construction loan gives you, even after the completion of the construction, you typically will still be able to have the same loan terms for 1 year after construction is completed. So in order to refinance, you'll need to have it stabilized, which means you'll need to have at least a 90% occupancy. In order to sell it, you also need to have it stabilized in order to present it as the best, in order to present it as a, in order to get the highest premium possible to sell it. Well, typically, in order to do that, what you're doing is you're giving a concession, meaning you're giving, new, what sort I'm looking for? You're giving new tenants basically a discount, right? Could be 50, could be 100, could be $200 a month, typically not that high, somewhere in the $100 range. So what's going to happen? Well, if you're in an area where there's, let's say there's 1,000 units within 3 miles, and you come in and let's say the market, let's just make it easy. The market rent is $1,500. And all of a sudden you're offering $1,400. Well, guess what? In order for the other apartments to, like the other apartment complexes, to keep their tenants, because a smart tenant is going to look at the market and see, okay, where can I get basically the same thing for less, right? In the same vicinity. Let's say you love the area, you put your tenant hat on. Okay, you love the area you're in, you want to stay there, but you don't want your rent to go up the $50, $75, $100 that it's going to go up due to just as rents do, right? Typically in the $50 range. So you jump online real quick and look, and you see there's this new apartment building that's just been built, and what was going to cost you $1,525 now to renew your lease, you can go get for $1,400. Well, what are you going to do? I mean, ideally, you don't have to. Nobody likes moving, right? So instead of moving over there to go get the $1,400, you just say, hey, this place, which is basically the exact same style, right? Like, they're all a little bit different, but in the end, they're all pretty much the same, assuming they're all the same class, right? Assuming you're not going A down to B or B down to C, right? You're staying at A, you're staying at B, you're staying at C. In this case, we'll call it A, just because we're talking about new construction. So you go to the property manager, say, well, this place is offering, basically the same for $1,400. What can you do? And they'll have no choice but to match it, right? I'm not saying like, oh, we won't bump yours, we'll leave it at $1,500. It's like, no, I want to save $1,200 a year, right? And you're willing to like move down the street, ultimately. And then, they have to have tenant turnover and all the costs that come with it. So they have no choice, right? There's all these costs that come with tenant turnover. They got to come in, they got to clean it, they got to fix anything that's, maybe there's, damage from you moving in or whatever it may be, right? Like maybe you had a pet, and so they've got it, right? So all these fees that are associated with tenant turnover, that comes on the side of the landlord. That's just a cost that they incur. So instead of them now getting what they thought was going to be from $1,500 to $1,525, they're now forced to bring you down to $1,400, right? So now what has happened is the whole market has no choice but to adhere to this or lose tenants, right, to this new apartment complex, which is going to fill up and get to 90% because they're $100 below market. So as you guys can see, right, this is simply one variable. This is literally just new construction. And so this plays into what they call the absorption rate. And, absorption rate plays into the economics of, new, how with the demand, right? What's the demand in the area for units? And, it ties into your vacancy rate for sure. Vacancy is a proponent of demand for sure, right? It's the most obvious one. but it's not all of it because, if some place is 80% occupied, that doesn't necessarily mean it's because there's no demand in the area for units. It could very well be that specific apartment complex itself and the ownership and property management and all of those things. So it's not the the key metric for that. So basically what I'm trying to get at is, with all of these new apartment complexes coming online, this presents a new variable that you should be paying attention to as you invest, even in these top markets like Phoenix and Austin and your other Sunbelts, Atlanta, Charlotte, let's see, and kind of your whole Sunbelt there, some of your Florida markets, like all these markets, it's very important to pay attention to that. So what does that mean? Well, absorption doesn't always typically mean a huge loss, right? It doesn't necessarily mean that, if the demand is there in a market, then in a market, then it's possible that it'll have no effect at all. It's very possible that if demand is there, that it'll have a minimal effect. Certainly it'll have an effect because, you're going to have tenant turnover and you're going to have people who leave. Even if you don't match, it's like, okay, well then, right, let's say you were about to raise rents for a tenant whose lease was coming due, right? Your typical, 3%, right, that the market has right now. And they're like, no, I'm going to go to this place that's 1,400. And you're like, all right, well, we'll keep it at 1,500 at best, right? And they're like, no, I'm going to leave. Okay. Well, it doesn't mean that you're never going to be able to fill that apartment at 1,500 or 1,525, right? It just means that, there's a tenant loss. So I don't want this to be like doom and gloom, like, oh my gosh, all these new apartments complex and NOIs are going to sink like crazy. Because that's not true. I'm just trying to make you aware of the details of what goes into market research and what you should be paying attention to in order to be the most effective when it comes to apartment research. Because, this could mean, this could be a really, really good question if, let's say, you're watching a webinar and, it's a new Phoenix thing and they don't say any, all they do is show you all the best demographic information for Phoenix, right? Like, oh, look at all these new jobs and X number of people are moving into Phoenix, year over year. And they say nothing about the new units that are coming online. Well, this is a perfect question to present in the Q&A. What do you have in place in order to, what are you doing to account for the absorption of these new units that are coming online, X units? And I'm not sure the specific of how many of those 950,000 are in Phoenix, but still a factor. There's a lot coming online there. And Phoenix has a pretty high absorption rate, but it's a really, really great question because if they don't bring it up, that's something you should ask. And so it's easy to ask the question. And, typically they'll have something in there like, oh, well, our break-even occupancy is, X, which is normally 75 to 80%, right? Meaning that they can withstand a drop in occupancy for, new apartments that are, coming online with these big concessions, right? And that's pretty typical, good underwriting should have that in place. So, that's essentially So that's essentially one variable to market research, right? And the reason I bring that up is because there's so many new apartments coming online, and we're seeing so much being built, and we're seeing a trend away from single family homes being built and a trend toward apartments being built. And so it's something to keep in mind. So it's important to understand absorption and to make sure that the operator you're investing with understands it as well, right? So for instance, absorption is essentially like, how many units are online and how many units are available, how many units are coming online, and what's the sort of average occupancy. And so that's going to basically give you the absorption. So for instance, let's say there's 300 units, right? And 75 are rented. Okay. So you basically divide 75 by 300, and that gives you 0.25. So that gives you a 25% absorption. Gives you a 25% absorption rate. Not that great. That means only 25% of apartments are getting absorbed. So what does that do? That could really crush you. That could seriously crush your revenue, because that means there's not a lot of demand, which means why wouldn't people leave and go to these apartments that are offering a lower rent, And maybe they're willing to give up some certain amenities. So, like I said, this is something to keep in mind. And so what I'm going to do is I'm going to launch a series of market research and essentially just talk about why, how you should be analyzing a market and how that plays into, again, analyzing vetting an operator and vetting their market research too. It's important too to understand market research, at least at a basic level, so you can make sure that their market research is, up to standard and they have correct information, right? And of course, like, it can be a little bit subjective, right? I mean, 1 or 2% here and there, like, that's not worth going crazy about. But, again, this is a good example of like, okay, if nothing's in there about absorption and the new units coming online, then, where do you guys have that baked in, in order to account for it? So anyway, there you have it. That's part one, really. And this was just a basic, like, really, this was just an episode to launch it. I think I'm going to keep this for Wednesday's episodes, and keep Friday a little bit more lighthearted. But if I'm being 100% honest with you, I was trying to find something kind of off topic to talk about today, and there really wasn't much. There was some stock market stuff. The S&P 500 is officially off its bear run, longest bear run since 1940. So that's good news. Also, some more good news for you guys. I just found out that there's a unit for sale where I live. So I live in a townhouse community. There's a unit for sale for $426. I'm not going to say what I bought my house for, but it's basically, I've almost pretty much doubled my house. So by that, I mean, I have doubled it. Now, this unit's a little bit different. It's a lot more modern. Not to say I couldn't bring mine up to that standard, but like, they put in all new windows and doors, and I'm not sure if I want to go to that length to sell it. I guess that would have been a good Friday follow-up. Maybe I'll do that for next Friday follow-up. I'll talk about housing and my housing and, different things you can look at in order to maximize selling your house. But I'm getting off topic here. So Wednesdays, now what we're going to do is I'm going to do a market research series, understanding market research, how to do it effectively, and then how to use that to ensure that the operators you're vetting and or investing with are, being effective as well, and not just showing you, the glitz and the glamour, and they're taking into account things like absorption and things like, crime rates and what block they're on and all of these things, right? And make sure they're aware of that. So Anyways, thank you guys so much for listening. As always, do not forget, you guys, the cashflowchronicles.com, same name as the podcast. Can't forget it. Go there, get on the list. We've got some exciting things coming, including the video series that I'm very excited for. As always, you can follow me on social media at Jonny Cattani. And I will talk to you guys next Wednesday. Thank you guys. See ya. Thank you again for tuning in. Who do you know that wants more cash flow? Share this episode with them so you can grow your cash flow together. If you enjoyed the show, make sure you're subscribed on your platform of choice so you never miss a new episode. Go to CattaniCapitalGroup.com to learn more.